All right, let's get into study session 15 around equity investments 2. It's a continuation of the equity investment section. The study session focuses on characteristics, analysis, and valuation of equity securities, various equity types, including public and private equities that are described. This various industry classification approaches to global equities and useful frameworks for conducting industry and individual company analysis are presented. Coverage of the three main equities valuation approach, present, multiplier, and asset based concludes this section. Reading assignments. We have 3 readings: overview of equity securities, introduction to industry and company analysis, equity valuation, about the concepts of basic tools. All right, let's get into overview of equity securities. Learning outcomes. The candidate should be able to describe characteristics of types of equity securities, describe differences in voting rights and other ownership characteristics among different equity classes, distinguish between public and private equity securities, describe methods for investing in non-domestic equity securities, compare the risk and return characteristics of different types of equity securities, explain the role of equity securities in financing of a company's asset, distinguish between the market value and book value of equity securities, compare a company's cost of equity and accounting return on equity and investments required rate of return. Introduction. Equity securities present ownership claims on a company's net asset. As an asset class, equity plays a fundamental role in investment analysis and portfolio management because it represents a significant proportion of many individuals and institutional investment portfolios. Okay. Equity securities and global financial markets. The section highlights the relative importance and performance of equity securities as an asset class. We examine the total market capitalization and trading volume of global equity markets and the prevalence of equity ownership across various geographic regions. We also examine historical returns on equities and compare them to the returns of government bonds and bills. Exhibit 1 summarizes the contributions of selected countries and geographic regions to global gross domestic product and the global equity market capitalization. Analysts can examine the relationship between equity market capitalization and the GDP equity market. And under over a fairly valued global equity market expanded at twice the rate of global GDP between 1993 and 2004. At the beginning of 2008, the global GDP equity market capitalization was nearly equal to approximately 55 trillion, and this implies an equity market capitalization of GDP of over 100%, which was almost twice the long-run average of 50%, and indicates the global equity market was overvalued at that time. I mean, it can still be argued it is now. As equity markets outside of U.S. develop and becomes increasingly global, their total capitalization levels are expected to grow closer to their respective world GDP contributions. Therefore, it is important to understand and analyze equity securities from global perspectives. So this is what it looks like. That's Exhibit 2. Exhibit 3 compares real or inflation-adjusted compounded returns on government bonds, government bills, and equity securities of 19 countries plus the World Index or the WOD and the World ex-US Index. And so here's just a comparison between the countries, which is quite interesting. It's quite a beautiful graph if you think about it. Exhibit 4 focuses on a real compounded rate of return on equity securities in the same 19 countries over 1900 to 2011, only in South Africa and in the Australian equity markets, but where better investments in real terms in the U.S. investors are their own equity market. Okay, so it's interesting that kind of goes less than 0 for some parts. The volatility of equity market returns is further highlighted in Exhibit 5, which shows the average performance of the worldwide equity market index in U.S. dollars, bonds, and bills. Okay, So, given the high risk levels associated with equity securities, it is reasonable to expect that investors' intolerance for risk will tend to differ across equity markets. This is illustrated in Exhibit 6, which shows the result of a series of studies conducted by the Australian Securities Exchange on international differences in equity ownership during 2002-2008. Equity investments as a percentage of the population was the lowest in South Korea, around 7.5, followed by Germany. In contrast, Australia, Canada, and the U.S. has higher equity ownership as a percentage of the population, average among 50. In addition, there has been relative decline in share ownership in several countries over recent year, which is not surprising given the recent overall uncertainty in global economies and volatility in equity markets that this uncertainty has created. So we can actually see international composition of stock ownership decreasing for Australia. It is important implication from above discussion that the equity securities represents a key. Let's see what U.S. is doing. U.S. is also decreasing. Okay, that's quite interesting. We next examine the various types of equity securities traded on the global market and their salient characteristics. Types and characteristics of equity securities. Companies finance their operations by issuing either debt or equity securities. A key difference between these securities is that debt is liable for the issuing company, whereas equity is not. This means that when a company issues debt, it is contractually obligated to repay the amount it borrows at a specified future date. The cost of using funds is called interest, which the company is contractually obligated to pay until the debt matures or is retired. When a company issues quantity equity securities, it is not contractually obligated to repay the amount it receives from shareholders, nor is it contractually obligated to make periodic payments to shareholders for the use of their funds. Instead, shareholders have a claim to the company's assets after all liabilities have been paid. Because of this residual claim, equity shareholders are considered to be owners of the company. Investors who purchase equity securities are seeking total return, whereas investors purchasing debt securities are seeking interest income. As a result, equity investors expect the company's managers to act in the best interest by making operating decisions that will maximize the market price of their shares. In addition to common shares, companies may also issue preference shares, other types of equity securities. The following section discusses the different types of characteristics of common and preference securities. Common shares represents an ownership interest in a company and are the predominant type of equity security. As a result, investors share in the operating performance of the company, participate in governance process throughout voting rights, and have a claim to the company's net assets in the case of liquidation. Companies may choose to pay out some or all of their net income in the form of cash dividends to common shareholders, but are not contractually obligated to do so. Voting rights provides shareholders with the opportunity to participate in major corporate governance decisions, including the election of a board of directors. Include this the decision to merge with or take over another company, and the selection of outside auditors. Shareholders voting generally takes place during a company's annual meeting. As a result of geographical limitations, there is a large number of the shareholders, and often not feasible for the shareholders to attend annual meetings in person, and especially with Rona. May vote by proxy, which allows designated parties such as another shareholder, a shareholder representative, or management to vote on the shareholder's behalf. Regular shareholder votings, that's just not really okay. Voting rights, the rights of the shareholders. As seen in Exhibit 7, and companies can issue different classes of common shares, Class A and Class B shares, which with each class offering different ownership rights. For example, as seen in Example 8, Ford Motor Company has Class A shares, or common stock, which are owned by the investing public. It also has Class B shares, which are owned by only the Ford family. The exhibit contains an excerpt for Ford's 2008 annual report, and Class A shareholders have 60 percent voting rights, whereas Class B shareholders has 40% in each case of liquidation. However, Class B shareholders will only receive 0.5 per share unavailable for distribution, whereas but they will receive next to $1 per share that is available for the distribution from Class A shareholders receive anything else. Thus, Class B shareholders have an opportunity to receive a larger proportion of distribution upon liquidation than Class A shareholders. So different classes in the stock. Common shares may be called callable or puttable. Callable common shares, also known as redeemable common shares, give the issuing company the option or a right, but not the obligation to buy back shares from investors at a call price that is specified when the shares are originally issued. It is most common for companies to call or redeem the common shares when the stock price is above the pre-specified call price. The company benefits because it can buy back its shares below the current market price and later resell them at a higher market price. Then can be reduced dividend payments to preserve capital. If required, investors benefit because they receive a guaranteed return when their shares are called. Exhibit 9 provides an example of a callable common share investor in genomic solutions in the U.S. market. Okay. Puttable common shares give investors the option or a right to sell their shares, i.e. put them back into the issuing company at the price that is specified when the shares are originally issued. Issuers and investors will generally sell their shares back to the issuing company when the market price is below the pre-specified put price. Thus, the put option feature limits the potential loss for investors. From the issuing company perspective, the put option facilitates raising capital because the shares are more appealing to investors. Exhibit 10 provides some example of puttable common shares issued by Draler's new subsidiary, Switzerland-based Nestle. Preference shares are stock ranks above common shares with respect to the payment of dividends and the distribution of company's net assets upon liquidation. However, preference shareholders do not share in the operating performance of the company and do not have voting rights unless explicitly allowed for the issuance. Preference shareholders have characteristics of both debt securities and common shares. Similarly to the interest payments of debt securities, the dividends and preference shares are fixed and generally higher than the dividends and common shares. However, likely interest payments, preference dividends are not contractually obligations of the company. Similar to the common shares, preference shares can be perpetual, can pay dividends indefinitely, and can be callable or puttable. Exhibit 11 provides an example of callable preference shares given by Goldman Sachs to raise capital during the credit crisis of 2008. In this case, Berkshire Hathaway, the purchaser of the shares, will receive an ongoing dividend from Goldman Sachs. If Goldman Sachs chooses to buy back its shares, it must do it at a 10% premium from their previous value. So this is preference shares. Dividends on preference shares can be cumulative, non-cumulative, participating, non-participating, or some combination thereof. Dividing cumulative preference shares. Cumulative, non-participating, cumulative, non-cumulative, participating, non-cumulative, and non-participating. Dividends on cumulative preference shares accrues so that the company decides not to pay dividends in one or more periods. The unpaid dividends acquire the most to be paid in full by dividends in common shares can be paid. In contrast, non-cumulative preference shares have no such provisions. This means that any dividends that are not paid in current or subsequent periods are forfeited permanently and are not over the time to be paid at a later date. However, the company is still not permitted to pay any dividends to common shareholders in the current period unless preferred dividend have been paid first. Participating preferences shares entitled to shareholders to receive the standard preferred dividend plus the opportunity to receive an additional dividend if the company's profits exceed a pre-specified level. In addition, participating preference shares can also contain provisions that entitle shareholders to an additional distribution of the company's assets upon liquidation above the par or face value of the performance shares. Non-participating performance shares do not allow shareholders to share in the profits of the company. Instead, the shareholders are entitled to receive only a fixed dividend payment of the value of the shares in event of liquidation. The use of participating preference shares is much more common for smaller, riskier companies, whereas the possibility of future liquidation is more concerning for investors. Preference shares can also be convertible. Convertible preference shares entitle shareholders to convert their shares into a specified number of common shares. This conversion ratio is determined at issuance. Convertible preference shares have the following advantages. They allow investors to earn higher dividends than they invest in the company's common shares. They allow investors the opportunity to share in the profits of the company. They allow investors to benefit from a rise in the price of common shares through the commission option. Their price is less volatile than the underlying common share because the dividend payment is known and more stable. As a result, the price use of convertible preference shares is a popular financing option in the venture capital and private equity transaction, in which the issuing companies are considered to be higher risk and when it may be years before the issuing company goes public. Okay. Private versus public equity securities. Our discussion has focused on equity securities that are issued and traded in public markets and on exchanges. Equity securities can also be issued and traded in private equity markets. Private equity securities are issued primarily to institutional investors through non-public offerings, such as private placement. Because they are not listed on public exchanges, they are not actively act as secondary markets for securities. As a result, private equity securities do not have market determined quoted prices, have highly illiquid, and require negotiations between investors in order to be traded. In addition, financial statements and other important information needed to determine the fair value of private equity securities may be difficult to attain because the issuing companies are typically not required by regulatory authorities to publish this information. There are three primary types of private equity investments: venture capital, leveraged buyouts, or LBOs. Okay. Private investment in public equity. Venture capital investments provide seed to start up companies, to start up capital, early stage financing, and the mezzanine financing to companies that are in early stages. Early stage development and acquiring additional capital. Leveraged buyouts or IBOs occur when a group of investors use a large amount of debt to purchase all of the outstanding common shares of the publicly traded company. In case where the group of investors acquiring the company is primarily comprised of the company's existing management, the transactions is referred to as the management buyout or MBO. After the shares are purchased, they cease to trade on an exchange, and an investor group takes full control of the company. In other words, the company is taken private or has been privatized. Companies that are candidates for these types of transactions generally have large amounts of undervalued assets, which could be sold to reduce debt and generate high levels of cash flow. So this is like the enterprise value, the EV. So when we subtract the outstanding debt of a company by the purchasing quantity or the purchasing price, therefore giving the enterprise value. So enterprise value is equal to the market capitalization minus any cash plus any debt. Okay. The third type of private investment is the private investment in public equity, or the PIPE. This type of investment is generally sought by the public company that is in need of additional capital quickly and is willing to sell a sizable ownership position to a private investor or investor group. For example, a company may require a large investment of new equity funds in a short period of time because it has significant expansion opportunities, is facing high levels of indebtedness, or it's experiencing rapid deterioration in its operations. Depending on how urgent the need is and the size of the capital requirements, the private investor may be able to purchase shares in the company at a significant discount to the publicly quoted market price. Exhibit 13 contains the recent PIPE transactions for the electronic retailer HHREGG, which also includes the issuance of additional common shares of the public. While the global private equity market is relatively small in comparison to the global public equity market, it has experienced considerable growth over the past 3 decades, according to the study of the private equity market sponsored by the World Economic Forum, and spanning the period of 1970 to 2007, approximately 3.7 or 3.6 trillion in debt and equity were acquired in leveraged buyouts. Of this amount, approximately 75% was transaction during the 2001 to 7 period, while the U.S. and U.K. markets were the focus of the private equity investment during the 1980s and 90s. Private equity investment outside of markets have grown substantially in recent years. In addition, the number of companies operating under private equity ownership has also grown. For example, during the that just shows the example. In operating a publicly traded company, management often feels pressured to focus on short-term results instead of operating the company to obtain long-term sustainable revenues and earning growth. By going private, management can adopt a more long-term focus and eliminate certain costs that are necessary to operate a publicly traded company, such as costs of meeting regulatory and stock exchange filing requirements, the cost of maintaining investor relation department to communicate with shareholders and the media, and the cost of holding quarterly analyst conference calls. As described above, public equity markets are much larger than private equity networks and allow companies more opportunities to raise capital than is subsequently actively traded in secondary markets. Where operating under public scrutiny, companies can incentivize to be more open in terms of corporate governance and executive compensation to ensure that they are acting for the benefit of shareholders. In fact, some studies have shown that the private equity firms score lower in terms of corporate governance effectiveness, which may be attributed to the fact that shareholders, analysts, and other stakeholders are able to influence management of corporate governance and other policies are public. Investing in non-domestic equity securities, technological innovation, and the growth in electronic information exchanges have accelerated the integration and growth of global financial markets. As detailed previously, global capital markets have extended at a much more rapid rate than global GDP in recent years. Both primary and secondary international markets have benefited from the enhanced ability to rapidly and openly exchange information. Increased integration of equity markets has made it easier to less expensive for companies to raise capital and to expand their shareholder base beyond their local market. Integration has also made it easier for investors to invest in companies that are located outside of their domestic markets. This has enabled investors to further diversify and improve the risk and return characteristics of their portfolio by adding a class of assets with lower correlation to local country assets. One barrier in investing globally is the is that many countries still impose foreign restrictions on individuals and companies from other countries that want to invest in the domestic companies. There are one barrier. Okay, I've read that part already. Technological advancements has made it easier for investors to trade shares in foreign markets. The German insurance company recently delisted its shares from the New York Stock Exchange to certain European markets because international investors increasingly traded in the shares of Frankfurt Stock Exchange. Exhibit 14 illustrates the extent to which institutional investors, direct investing investors can use a variety of methods to invest in the equity of companies outside of their local markets. The most obvious is to buy and sell securities directly in foreign markets. However, this means that all transactions, including the purchase and sale of shares, dividend payments, and capital gains, are the company's, not the investor's, domestic currency. In addition, investors must be familiar with the trading, clearing, and settlement regulations and procedures of the market. Investing directly often results in less transparency and more volatility because additional financial information may not be provided on a regular basis, and the market may be less liquid. Alternatively, investors can use such securities as depository receipts and global registered shares, which represent the equity of international companies and are traded on local exchanges. And in local currencies, which these securities investors have to worry less about currency conversion. Unfamiliar market practices and differences in accounting standards. The section that follows discuss various securities that investors can invest in outside their home market. The depository receipt, or the DR, is a security that trades like ordinary shares on a local exchange that represents an economic interest in a foreign company. It allows publicly listed shares of foreign companies to be traded on an exchange outside the domestic market. A depository receipt is created when the equity share of a foreign company are deposited in a bank in a country of whose exchanges and shares will trade. A depository then issues receipts that represents the shares that were deposited. The number of receipts issued and the prices of each DR is based on a ratio which specifies the number of depository receipts and the underlying shares. Consequently, the DR may represent one share of the underlying stock, many shares of the underlying stock, or the fractional share of the underlying stock. The price of each DR will be affected by the factors that affect the price of the underlying shares, such as company fundamentals, market conditions, analyst recommendations, and exchange rate movements. In addition, any short-term valuation discrepancies between shares traded on multiple exchanges represent a quick arbitrage profit opportunity for astute traders to exploit. The responsibilities of depository banks that issues the receipts includes acting as custodians and as a register. Okay. Global depository receipts, American depository receipts, global register shares. A global register of shares is a common share that is traded on different stock exchanges around the world in different countries. Currency conversions are not needed to purchase or sell them because identical shares are quoted and traded in different currencies. Thus, the same shares purchased at the Swiss exchange in the Swiss franc could be sold in the Tokyo exchange in the Japanese yen. As a result, GRSs offer more flexibility than depository receipts because the shares represent an acting ownership interest in the company that can be traded anywhere, and currency conversions that are not to repurchase or sell them. The GRSs were created and issued by Daimler Chrysler in 1998. Basket of listed depository receipts under the type of global security is a basket of listed depository receipts, which is an exchange-traded fund An ETF that represents a portfolio of depository receipts. The ETF is a security that tracks the index, but trades like an individual share on an exchange. An equity ETF is a security that contains a portfolio of equities that tracks an index. It trades throughout the day and can be bought, sold, or short, just like any other shares. Just like shares, ETFs can be purchased on a margin and had a hedging or arbitrage strategies. Risk and return characteristics of equity securities. Different types of equity securities have different ownership claims on a company's net asset. The type of equity securities and its features affect its risk and return characteristics. The affecting security discussed the different returns and risk characteristics of equity securities. Return characteristics of equity securities. There are two main sources of equity securities: total return, price changes, and dividend income. And price changes represent the difference between the purchasing price and the sell price, and the shares on the end of the term, respectively. Cash or stock dividends represents distribution that the company makes to its shareholders during period T. Therefore, an equity securities total return is calculated as such. For non-dividend paying stocks, the total return consists of price appreciation only. Companies that are in earning stage of their life cycle generally do not pay dividends because earnings and cash flows are reinvested to finance the company's growth. In contrast, companies that are in mature phase of their life cycle may not have as many profitable growth opportunities. Therefore, excess cash flows are often returned to investors through the payment of regular dividends or through share repurchases. For investors who purchase depository receipts or foreign shares directly, there is a third source of returns: foreign exchange gains or losses. Foreign exchange gains arise because the change in the exchange rate between an investor's currency and their currency at the foreign shares are denominated. For example, the U.S. investors who purchase ADRs in Japanese companies will earn an additional return in the yen appreciated relative to the U.S. dollar. Conversely, these investors will earn a lower total return if the yen depreciates relative to the U.S. dollar. For example, you get the point. Investors only consider price appreciation, overlooked an important source of return: the compounding that results from reinvested dividends. Reinvested dividends are cash dividends that the investor receives and uses to purchase additional shares. As Exhibit 17 shows, in the long run, total returns on equity securities are dramatically influenced by the compounding effect of reinvested dividends. Between 1900 and 2011, $1 invested in U.S. equities in 1990 will have a real return of 834 with dividend reinvested, but to just 8.1 when taken only on the price of appreciation or capital gains into account. This corresponds to a real compounded return of 6.2% per year with dividends reinvested versus only 1.9% per year without dividends reinvested. Risk of equity securities. Equity securities and company value. So just basic stuff. All right, summary. Equity securities play a fundamental role in investment analysis and portfolio management. The importance of this asset class continues to grow on a global scale because of the need for equity capital and develop emerging markets, technological innovation, and the growing sophistication of electronic information exchange. Given their absolute return potential and ability to impact the risk and return characteristic of portfolios, equity securities are of importance to both individuals and institutional investors. This reading introduces equity securities and provides an overview of global equity markets. As detailed analysts and their historical performance shows that equity securities have provided average real annual returns that have only kept pace with inflation. The different types of characteristics is common and preference equity securities that are examined. The primary difference between public and private equity securities are outlined. An overview of various types of equity. We conclude a summary of the key components of the rating shareholder. Common shares represent an ownership interest in a company and gives investors a claim on its operating performance, an opportunity to participate in operating decision making, a claim to the company's net asset. In the case of liquidation, callable common shares give issuers the right to buy back the shares from shareholders at a price determined when the shares were originally issued. Puttable shares give the shareholders the right to sell the shares back to the issuer at the price specified when the shares are originally issued. Preference shares are a form of equity in which payment made from preference shares take precedent over any payment made to uncommon shareholders. Cumulative preference shares are preference shares on which dividend payments are accrued, so that any payments omitted to the company must be paid before another dividends can be paid to the shareholders. Non-cumulative preference shares do not have such provisions, implying that the dividend payments are at the company's discretion and thus similar to the payment made from common shareholders. Participating preference shares allow investors to receive the standard preferred dividend plus the opportunity to receive a share of corporate profits above a pre-specified amount. Non-participating preference shares allow investors to simply receive the initial investment plus any accrued dividends in the event of liquidation. Callable and puttable preference shares provide issuers and investors with the same rights and obligations as their common share counterparts. Private equity securities and issued primarily to institutional investors through private placements and do not trade in secondary equity markets. There are three types of private equity investments: venture capital, leveraged buyouts, private investment, public equity. The objective of private equity investing is to increase the ability of the company's management to focus on its operating activities for long-term value creation. The strategy is to take the private company public after certain profits and other benchmarks have been met. Depository receipts are securities that trade like ordinary shares on a local exchange, but which represent an economic interest in a foreign company. They allow the publicly listed shares of foreign companies to be traded on an exchange outside of the domestic markets. American depository receipts are U.S. dollar dominated securities trading much like standard U.S. securities on U.S. markets. Global depository receipts are similar to ADRs, but ADRs, but contain certain restrictions in terms of their ability to be resold among investors. Underlying characteristics of equity securities can greatly affect the risk of a company and companies' accounting returns on equity and the total returns that are owned on the shareholders' book equity. A company's cost of equity is the minimum rate of return that shareholders require the company to pay them for investing in the equity. And thus is reading 49. Don't forget the Amazon show notes. The show notes are in the description where you could go to Amazon and get the notes. I do hope my readings have been helpful and hope to see you guys next time for reading 48. Goodbye.